Hi, thank you for checking out April 2021's Public Finance Conversation. My name is Adam Bauer, and I serve as CEO and President of Philman Roll-Up and Associates. And this month, I'm joined with Glenn McGowan, Director and Senior Municipal Underwriter for RBC Capital Markets. Glenn, thank you for joining us.
Thanks for having me, Adam.
Great. Well, we have 3 questions that we're hopeful to walk through today, and we'll release those on 3 separate days. But with the amount of activity that Glenn sees, both doing a lot on the West Coast and also nationally, we thought he'd be a great guest to walk us through some of the things that might be on the horizon, but also some things that we've seen in the market recently. And so for our first question, 2021 has seen a shift in the yield curve for the intermediate and longer term maturities. They both have gone up to some degree. But they have not gone up to the same degree that treasuries have of similar maturity status. Do you think that municipals will stay on the lower because of things like potential tax increases, or are there other things that are driving them down, or one day allow them to catch up to treasuries?
Yeah, thanks, Adam. Very good question. I think there's no secret that over the last several weeks and months, we've seen some upward pressure in interest rates generally. And really, that's a result of what we call the reflation trade, this idea that federal government stimulus is driving economic growth, but along with it, interest rates are moving higher on inflation expectations moving up as well. Last week, we had a CPI number that came in a little bit higher than forecast. The week before that, we had a PPI number that came in a little bit higher than forecast. And in the actual economic growth data, whether it's GDP or the Fed's forecast for GDP going forward, we're starting to see some significant growth start to materialize. And the expectation is that will continue. As we have this dynamic play out, it has inflationary pressures, obviously, and you can see that on a real-time basis in certain financial markets, whether that's the commodity markets for base metals or for energy commodities, whether it's stocks recently near all-time highs. And that all happens at the expense of treasury yields. So this idea of a growth trade helping out the risk markets, helping out equities, helping out corporate credit, helping out commodities, really comes at the expense of the safe haven asset of treasuries. So from the all-time lows, on the 10-year note, which was a 50 basis point yield back on August 4th, we've seen a movement on the 10-year Treasury to the tune of about 107 basis points. But you noted in your question that we haven't seen the same impact of rates moving higher, one-for-one basis with MMD, and that's true. On Friday, MMD closed in 10 years at 93 basis points. And that's only 35 basis points higher than the all-time low, which we also hit in that first week of August. So we have seen upward pressure in rates in the bond markets generally, and that has impacted MMD. But the tax-exempt market has outperformed the Treasury market in that leg higher in rates. So whether that continues or whether that sort of reverts to a more normalized ratio relationship, I think really is going to depend on the technicals. We are starting to see supply pick up on a year-over-year basis. And right now we're up about 20% year over year. But that number in and of itself can be a little bit misleading, because back in March and April of last year, when COVID first gripped the market, we saw a significant slowdown in municipal new issue supply. So really, I think over time, we will see a pace of supply that's higher year over year. But the 20% number, I think, is exacerbated by what happened exactly a year ago. But I think when you get into the technicals of it, we've seen a pretty significant trend of performance on the part of municipal fund flows. Just last week, we got our second consecutive week of inflows over $2 billion. And if you look at the weekly reporting numbers, we've had about $22 billion of positive fund flows so far this year. And that's just for the weekly reporters alone. If you look at weekly and monthly reporters this year, so those mutual funds that report their fund flows either weekly or monthly, you combine that two data subsets together, you have about 38 billion of positive fund flows this year. So that's driven significant demand in our marketplace. In particular, it's been great to see capital return to the high yield sector of the marketplace, credits that historically might have been a little bit more stressed, or sectors that might have been a little bit more impacted by COVID, benefiting from a very strong pattern of demand. But we're seeing that as well in the high grade sector of the market. So I think the bottom line is, yes, we're seeing an uptick in supply, but the strong technicals in our marketplace of positive fund flow fund flows, and what has really been manageable supply, even though it is starting to tick up, that has been propelling our demand. And I think if we have some overall stability in interest rates, which we've certainly had over the last several weeks, then that could drive continued outperformance on the part of municipals.
Good. Thank you.